slower but higher. That's our topic on today's Backstage Pass. Well, greetings, friends. Stocks and bonds are down so far today at midday, following up after the Fed's two-day meeting that concluded yesterday with their announcement in the press conference. Mortgage bonds right now, they're down about 20 basis points at the time of recording. The 10-year yield is up about 7 basis points, trading at about 4.13, 4.14%, somewhere around there. Yesterday, the national average for a 30-year fixed-rate mortgage, well, that rose just a little bit to about 7.3%. Now, look, the Fed's announcement yesterday came in, and it was mostly in line with what was expected, except for maybe a slightly more hawkish tone than what was expected. And here's what they said. Fed said that they are still watching the data very, very closely, that they want to slow down the rate at which they are hiking rates. If you remember, they've hiked the Fed fund rate by 75 basis points the last couple of meetings now. They want to slow this pace down, maybe not hike quite as much, but their target rate that they initially had targeted to be where the Fed fund rate was going to land, they're saying now they're thinking they're going to have to make that a little bit higher, raise that target rate. So what that means is that in December, there's probably going to be another Fed fund rate increase. And then their next meeting at the beginning of the year, maybe even two meetings into the beginning of the year, there may be more rate increases as well in those meetings. Now, the markets interpreted this negatively, and basically the markets are looking at this and they're saying, okay, inflation's still not under control. The Fed's still going to have to do more tightening in order to get inflation under control. And so the markets, again, they negatively interpreted that. For stocks, that means that the Fed is going to continue to tighten monetary policy and it's going to continue to shrink the economy. For the bond market, well, their bonds are just saying, hey, inflation's not under control yet. We're still, again, inflation is the enemy of the bond. So the bonds are saying, look, inflation's still going to be hurting us for the foreseeable future. That's the way it's been interpreted, and it followed through into today and in today's trading. Although I will say that bonds are well up from their worst levels of the day. Now, the things that are going to be consequential next, what we're going to be following, it's the data. This week we have jobs data. Today we got initial jobless claims, and initial jobless claims for the month of October stayed steady at about 217,000. Continuing claims, these are people that have initially filed for unemployment and they are continuing to collect on unemployment. Well, that has risen by about 47,000, and that continues to rise, and it's been kind of a significant rise, that continuing claims. It's been a significant rise for the past few months. And basically what that means is, and it kind of lines up with some of the news and the stories that we've heard, is that employers are holding on to their people as long as they can, but once people are let go, it's harder for them to find a job. And so that's what the data is kind of telling us out of initial jobless claims for today. Tomorrow we get a big BLS jobs report. And this jobs report should show that it's expected to show that there were 200,000 jobs created in the month of October, and unemployment is expected to lift from 3.5% to 3.6%. Now, next week, we've got the all-important CPI data. For the past few months, the CPI data has played a major role in the market, and again, we think it's going to play a major role this month as well. This Consumer Price Index, it's a measure of inflation, and if CPI data comes in at expected or worse, then it's going to be negative for the bond market. These two data points, the jobs data tomorrow and CPI data next week, these two data points are really going to set the tone for mortgage bonds and for mortgage rates for the rest of this quarter. Now, that's all the news that we have for today. Don't forget, stay positive. If you have any questions, be sure to leave a comment. Don't forget to like and subscribe. Hope you have a great day, and we'll see you tomorrow.